Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to hit that subscribe button for the latest. Recently, outgoing Cleveland Federal Reserve Chief Loretta Mester urged for clearer communication from the Fed. She believed that helping the public understand the rationale behind policy decisions can help manage expectations and minimize market volatility. Meanwhile, Fed Chair Jerome Powell announced that there would be only one rate cut for the rest of the year, despite rising unemployment and mixed economic data. Now, this decision comes after a series of economic indicators such as CPI and PPI missing expectations and a decline in the City Economic Surprise Index. Now, the Nasdaq has been performing well, but other sectors are struggling, raising questions about market leadership and diversification. Joining us to unpack all this is Thomas Fitzpatrick, Managing Director of Global Market Insights at R.J. O'Brien and Associates, to share his expertise on how to stay ahead here. Tom, good to see you. Welcome back to the show.
Jeremy, thanks very much for having me again. Good to be back.
Yeah, let's talk a little bit about the Fed. I mean, there's lots going on this week, but with the Fed signaling only one rate cut for the rest of the year, despite rising unemployment and inflation, are they making the same mistake as they did back in 2020, 2021? Are they being too cautious here?
So they're not making the same mistake. They're making a different one. And they're making a different one because Fed policy for me, and not just in this cycle, but in other cycles, has constantly been about avoiding the mistakes of the prior cycle. So if you sit here today and you look at the mistakes of 2021, it clearly was when we looked at the greatest fiscal and monetary stimulus in the history of mankind, and the expansion of the Fed's balance sheet, and the pace with which the economy and financial markets picked up. Too much free money was left in the system. They called inflation transitory because they were fearful of raising rates too quickly because they felt they pulled back the accommodation too soon after the great financial crisis. And as a consequence, they didn't want to make that mistake. Now, because of the mistake on inflation, they're fearful of a mistake of allowing inflation to catch hold again. And therefore, as a consequence, are prepared to wait longer until they are fully convinced, which in my view almost certainly means that by the time they are fully convinced, they are also once again behind the curve.
Mm-hmm. Okay, well, so then let's talk about how this is going to affect the economy. And as we mentioned, the stock market, maybe over the next 6 months. I mean, we have a big year coming up here, Tom.
We certainly do, and obviously the election cycle coming through as well. I see a lot of similarities here. When we look at things, we often try to think of, okay, have we got any historic comparison? A lot of people recently have tried to focus on the 70s as an historic comparison to inflation. I do think there are a lot of differences, and in particular, that was driven by, an oil price that multiplied by more than 20 times. Well, when we look today, I think we see some similarities to 2000. And if you look back to 2000, we were getting this very strong stock market move, the dot-com bubble, effectively, driven by the new technology revolution. And we're seeing a little bit of that here, but it's around AI. And any company who even mentions they're using AI sees the stock move up exponentially immediately, exactly the same as the dot-com. We had come off a bit of a crisis, a different crisis then. It was the Russia long-term capital Asia crisis that the Fed had reacted to. They came back and started tightening. They took real rates to about 400 basis points. They were very focused on the inflation dynamic, and monetary policy became very tight. And I think we're seeing a lot of similarities today with that. I mean, you mentioned the equity markets, and certainly, yes, if you look at the S&P and you look at the Nasdaq, for example, they've continued to perform well. I think when I was on the last time, I was talking about maybe having a situation where we might see some jitteriness in the equity markets after the end of the first quarter, which was kind of what we saw in 2000. You don't really see it if you look at the S&P and the Nasdaq. But I think you do see it if you look at the Russell 2000, if you look at the regional banks index, if you look at the bank index, if you look at the Dow Jones Transports, which has always been, one on Dow theory that has been an important one to watch. So I think there are some signs in the background that telling you that you should be a little bit more cautious. And if the Fed does hold this line, then there could be a danger that even with these, stocks that are performing so well, the small number of stocks that are keeping the indices up, they like this scenario recently where we've seen yields move down a little bit. They like the scenario where the Fed is even talking about cutting. But if we move into a scenario where they think the Fed is behind the curve, if they move into a scenario where the downward movement in rates we've been seeing is because the market is getting increasingly concerned about the economy and in particular employment, then I think there's a danger those equities don't start to perform or don't continue to perform as well as they have been doing today.
Right. Yeah. And we talked a little bit about this, the concentration of the Mag 7, which we'll get into. But, to your point, Tom, if the Fed stays on this path, what risks do you see for the stock market, especially outside of the tech sector that we just talked about? And more importantly, how do investors adjust their strategies to handle these risks or to find opportunities in this market?
I mean, I think if we look at what is going to shift the goalposts here, and thereby, change the narrative a little bit, it's not really going to be unemployment. It's not really going to be inflation, I should say, because the Fed felt that as we came into the start of this year, the base effects on inflation, where we were losing a lot of high numbers in the first 5 months of 2003, replacing them with the first 5 months of 2024, that we would see a significant downturn in inflation. And that really didn't happen. It was a little bit less than normal in that respect. The main reason it didn't happen revolved around car insurance and revolved around shelter, whereas a significant number of the components in inflation are running at or below 2%. But it's made the Fed feel a little bit more cautious. We know those base effects normalize now. So the numbers we're going to be losing now are going to be a lot lower. And therefore, as the Fed itself alluded to, it's going to make it more difficult to see that year-on-year number, even though that's not necessarily what we should be focusing on. It's going to be a bit more difficult to see that come significantly lower. So if the Fed is going to make any adjustment other than what's being guided, it's going to come down to employment. And I think that's true for the stock market as well. Because if the employment picture does deteriorate, that will likely have a direct feedback loop into earnings. And as a consequence, therefore, will probably affect the broad market. And I think in that instance, you probably got to start thinking of shying away from discretionary spending and focus more on companies that provide necessities in life, because at the end of the day, the limited discretionary spending capability of the consumer is still going to need the necessities. So, possibly we'll see a situation where some of the staples, some of the boring stocks will actually start to perform a little bit better. And some of the high-flying ones, maybe at that point in time, might find themselves coming under a little bit of pressure.
Yeah, a little bit of a correction there. And I mean, a lot of people still taking some profits at this point. Okay, Loretta Mester has been pushing for clearer communication from the Fed. I mean, she thinks that they should be more transparent about their policy decisions. How important is this for market stability? And what changes would you suggest based on her ideas?
I think she's right. I think probably the first change I would suggest is get rid of the dots. The trouble with the dot plot of the Fed is twofold, I think. Number one, it incorporates all of the Fed members, including a lot of non-voters. So it distorts what actually might be the core vote in there. And number two, it's very dependent on the Fed's future forecasting being right. And if you take one example of that, the Fed has forecasted that we may rise to 4% unemployment by year end. We're there. We've still got 7 months of prints to go between now and year end, and we're already at 4%. So I think in terms of communication, probably twofold. I think she's exactly right. They need to be better on the communication. They need to recognize that the dot plot revolves around forecasting and is not necessarily therefore very productive because it'll continue to change and can create, an element of confusion. I think they need to be prepared to say simply, they will do whatever it takes to ensure that their dual mandate is sustained, which is low inflation and high employment. Whereas if you take where we're at the moment, for example, I would say the confusion in communication is if the majority of the CPI, PCE numbers are running below 2% and we're being held up essentially by two supply-driven inflation indicators, which are shelter because of a lack of supply, and car insurance. Nobody's going out and buying multiple amounts of car insurance at the moment because car insurance prices are going up. So that should be looked through and realized that essentially inflation is more moderate overall. But because they are fearful of the mistakes they made before, they focus on the headline rate. But then when you come to unemployment, and we have seen unemployment rise from 3.4 to 4% since effectively the lows were put in last year. If you look back over a history of nearly 50 years, if you see unemployment come more than 0.5% off the lows, on average in the following 6 months, it's moved another 1% higher, and it's never moved less than 0.4 higher, which if you take a 3.4 low and getting to 3.9 as being the measurement, that would suggest we could be at 4.3 by August, much higher and much earlier than the 4% in December. And we're seeing initial claims now deteriorate. We're seeing job openings drop at a level never seen before. But the Fed in this instance chooses to pick effectively non-farm payrolls, which has a huge disconnect, obviously, against the household survey, because non-farm payrolls calculates jobs. The household survey calculates people employed. So the ironic thing is, if a lot of people are now finding themselves with no savings, are finding inflation eating away at their money, are beginning to struggle, what do? They take second or third jobs. You see a lot of jobs in the hospitality industry. How many people are going out and bartending and working at restaurants to generate some extra income? So on the face of it, you look at a non-farm payroll number and it looks positive. But if you look at it and compare it to the household survey, and if you look at it that it's essentially part-time jobs being created, then the employment picture is not nearly as positive. And I think that's why you get this sentiment. Everybody talks about the fact, why is the average consumer so downbeat? And I think that's it, because actually for them, things aren't actually so good at the moment.
Right. Yeah. Okay, so does the Fed's current path make sense to you? I mean, how do we interpret these signals? Because as you mentioned, we got the S&P 500 making new records, but it almost becomes the Magnificent Seven now is just a select few companies that have been involving AI in their press releases. Give me a little lay of the land here. How do we interpret these signals and what do we do?
So I think you're exactly right. The indices that are being held up because those indices have those companies in them. Whereas the more broad-based indices, as we talked about, the transports, the banking industry, the Russell 2000, etc., they have not been performing nearly as well. In fact, some of the bank indices have actually been hitting the lows of the year. So I think that in itself is giving you a little bit of a warning sign. We've got to be careful. Obviously, the dots suggest that there'll only be one hike, but it's purely a mathematical calculation of the median of the expectations of individual members. And as Chair Powell told you, it's not actually a forecast, and it wouldn't take much of a shift to get back to 2. But if you look at where we are, and as I said, if you look at the bones of unemployment, I would say it's much worse than focusing on a non-farm payroll picture suggests. If you look at the bones of the inflation numbers, it's actually a lot better than the year-on-year headline numbers suggest. So to me, that would suggest that if we truly were in a situation of one cut, or if we followed maybe even the 2000, let's think about what happened in 2000, because we were getting some of this then. Fed refused to cut. It didn't cut for the whole of 2000. What did it result in? It resulted in a cut in January 2001, and the first 5 cuts by the Fed were 50 basis points each because they got caught so far behind. So the danger to me is that the longer that they hold the line here and try and avoid cutting for the reasons I mentioned, a fear of repeating the mistakes of 2020, 2021, the greater danger that when it comes, they're going to get caught behind the curve and have to cut more. There'll be a point in time where that will be good for the equity market again, but a Fed being behind the curve in general is unlikely to be good for the equity market. And I think the danger is with some of the stratospheric levels we've seen in individual stocks and the market, there may not be a lot of places to hide later in the year, particularly if this employment picture does deteriorate. If employment holds up, then we probably just continue to push along because the market will see things in balance. As long as that's not deteriorating, they'll say, well, that's fine. We keep the pressure on inflation and we don't need to move because it's not filtering. But also let's remember the economy. We don't know what the second quarter will be. Real growth in the economy in the first quarter was 1.3%, which means that we have finally, from levels at one stage as high as 12% nominal growth, we're now down to nominal growth levels that are below the level of interest rates, which makes it very difficult for sustained economic growth when interest rates are above, what you're seeing at the moment in terms of nominal growth. So I think there's a likelihood that we could have some difficult times and some difficult decisions. Having said that, I think Chair Powell did lay it out very clearly. He didn't see much on the inflation front that would shift the needle for them. And that's because with the low base effects, that year-on-year rate probably won't change dramatically in the coming months. But he left the door open on the employment picture. And I do think if we start to print a 4.1 or a 4.2 in unemployment as we move into the third quarter, or a 4.3 as suggested by the historic references, the Fed will shift and we'll get at least 2. And it could actually shift. I think July at this point in time obviously is very unlikely, but we still have a host of initial claims numbers. We still have an unemployment number to come between now and then. We still have a jobs number. We're going to have a lot more information on the employment picture. If that suddenly deteriorated, funnily enough, like it did in June of 2000, when out of nowhere we printed 11,000 in non-farm payrolls, then it could even make July look a possibility. Let's not forget the July meeting is the 31st of July. So we still have quite a long way to go, over 6 weeks to go to that. A lot can happen between now and then. So I think there's a danger that we could see another shift. I'd almost go as far as to say, I think one cut is probably the least likely scenario we're going to see. Why? I mean, why are you going to bother at that stage with an election coming as well? And are they really going to cut if they haven't cut before the election? And let us say that Donald Trump is elected with the fiscal policies that he actually intends. Are they really going to cut? So a no cut, or a situation where things start to look a lot less robust in the next couple of months, and a 2 or a 3 cut, to me, look more likely than a 1 cut.
Okay, interesting. And I mean, that could be interesting for the markets too. They often forefront price in these cuts much before. We talked a little bit about the tech sector's dominance. Should investors then, let's think short term, should they be diversifying into other sectors? I mean, you mentioned transport, banks. We talked about the Russell 2000, some of the small caps. Where do they go to? Or are there specific tech stocks that maybe in this environment you just chatted to still has room for growth?
I mean, obviously, as we've mentioned before, I will kind of refrain from talking about individual stocks, but there are a lot of, for want of a better word, behemoths in the tech sector. Some of them have very different present and forward-looking PEs than others. And I think, therefore, if you were to continue to look, then I think maybe what you do is you focus more on the ones that clearly for a long period of time have had a sustainable business model and sustainable profitability, rather than maybe the new kids on the street that have really been surging and soaring this year. And I don't think I need to mention those names. Everybody knows, who the prime tech stocks of the last 4 or 5 years have been. They might be a better place to be, I think, than ones that have gone stratospheric, as we've seen. History is littered with these stratospheric moves followed by these very deep corrections. Even some of the top tech stocks of today went through that in their growth period. So I think that's certainly one thing you could do. I don't think we have a setup yet until we get much more into an environment where it's clear the Fed is going to be more proactive. I don't think that's necessarily going to be good for financial stocks, so I'm not sure I'd be rushing in there at this point in time. I think these high interest rate structures drag on regional but also on national banks. I think some of it comes back to staples. I think if you think we're going to get, even if it's not a deep downturn, let's go back to 2000, 2001, the actual economic downturn, despite a very big fall in the NASDAQ and the dot-com bubble being burst, the economic downturn was actually quite shallow. And therefore the money will still gravitate towards where people need to spend money. you already had consumers saying they're not maybe going to eat out as much. You'll probably find they'll be a bit more cautious in terms of the holidays if that disposable income is not there. But I think, the staple side of the equation, and then if you want to have still some of that exposure to, the growth side and the technology side, then maybe some of those core companies that have performed over the years might be a better place to be parked in the months ahead while we see how this pans out, than necessarily the high flyers that have done spectacularly well to date, but are very elevated in price, very elevated in PEs, very elevated in forward PEs.
Yeah. Tom, you've been at Citibank prior to your current role for over 30 years. I mean, you've seen a lot of things in this market. Some investors also go into safe havens. I mean, we've certainly seen central banks do it. Before I let you go, gold prices are hovering around that $2,300 mark, and it's been there for quite a while. There's a recent decline in industrial metals like copper. What does this tell us about the market sentiment and investor confidence? And more importantly, is this a temporary phenomenon, or do you think it's a longer term trend with this, these cracks in the economy that we're talking about?
So I think if you look at gold, obviously everybody thinks of it, as you say, as that kind of safe haven. And the environment that's easiest for gold to go up in is clearly if rates are dropping and if the dollar is weakening. And we have seen that, and that's what took us in this rise that we saw in gold and an even more exponential rise in silver. But I think recently you've noted that even when we've seen little episodic periods of that, gold and silver are struggling to maintain the momentum like they did before. And I think that's a combination of one, some indications that some central banks, you particularly had some comments from China that they weren't necessarily buying as aggressively as they had before. So I think that's a sense of a trend that's maybe gone a little bit too far, too fast. And if I look at, things like you've mentioned the industrial metals, copper, it definitely looks like it could correct further. That was another one that came up very aggressively. But even gold and silver, I'm a little bit cautious of because we're not getting this big push of dollar weakness. Part of that probably being that, whatever problems the US has, other places in the world also have problems. If you look at Europe, we have political and economic problems. If you look at China, we have economic problems. If you look at Japan, we've got growth problems. So as a consequence, at this point, it's not feeding directly into a much weaker dollar. And it looks like, precious metals are owned. But if we did get the retracements that it would suggest, I mean, to me, it looks like there could be a danger if we break through this area around 2277 on gold, on cash, we could be looking at 2100. We could be looking at $26 on silver, maybe even $25. But I do think this backdrop probably does favor them over time. And I think if we see that, then that's probably an opportunity at that point in time to look at gold and silver again as things that would move to the top side. I'd probably be a little bit more cautious on industrial metals and on energy, because if there is some sort of sign that the economy is actually flagging a little bit, the global economy is flagging a little bit, then I think their ability to turn up in that instance is probably more restrained than you might see in something like gold and silver.
Yeah, interesting. I mean, a lot of gold bugs also looking at things like BRICS. There was a new report from Russia saying that they're trying to settle the majority of their trade in rubles as well as in the RMB. Is this, when you're looking at it from your perspective, analysis-wise, is it just market noise or is this more fundamental?
It'll probably be fundamental over a long period in time. But I think as a consequence, it probably makes it market noise over the short period of time. I think during, this whole COVID crisis and obviously the follow through in terms of the Russia invasion of Ukraine, we did a lot of things in terms of the way we focused on the payments system, in terms of the way we appropriated assets of places like Russia, that I think out there probably have some, at the margin, sovereign nations a little bit concerned about the level to which they would necessarily want on a long-term basis that exposure. However, to adjust to it that dramatically on a short-term basis is a bit like, shooting the toes on your own foot. It's like, dumping your whole equity market position in an instant. But I do think there could be some implications. I think we have to recognize that we get away with the type of deficits we have and possibly even some of the policies we have because we're the world's reserve currency. But I think, many commentators have already talked about the unsustainability of our debt position. At this rate next year, our interest payments are going to be the single biggest line item in our budget expense, passing everything else out. And that is clearly, while, we could go to the Reagan years and say deficits don't matter, they don't till they do. And they do when you're getting to a point where you're literally looking at a scenario potentially having to borrow money to pay the interest on the existing debt you have. I think that's the type of thing that can create, an extra layer of confidence. But that's probably not today, tomorrow, next week, or even in the time frame that the markets would focus on. But it is something further down the line that certainly could rear its ugly head, I think, again. But that could be over the years to come, rather than probably the months to come being the more likely time frame most people are focusing on.
Yeah, well said. The Fitz. Thomas Fitzpatrick joining us today from O.J. O'Brien and Associates. Thanks again for unpacking this all. Great information, and I'm excited to have you on just prior to this election term. Let's see what your picks are.
Thanks a lot, Jeremy. It's great to have you. I should say it's great to be on again.
Of course. Appreciate your time. Thanks again. I'm Jerry Szafron for all of us here at Kitco News. Thank you for tuning in. Don't forget to hit that subscribe button and stay tuned for notifications. More great content coming your way.